Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. Volatility. That's what we're dealing with right now in the bond markets. When we look at the Treasury on Friday and into today, heading up to 2.88%. A huge move up in Treasuries. Why is it happening? Well, is it the fact that the U.S. is different than other countries in terms of rates? Well, we look at across the world that we're at that 288, Japan at 0.76, Germany at 1.9, Great Britain at 2.74. Have these markets also had any significant changes in here? And we see that Japan, flat as a pancake. We've seen a little bit of move up in terms of German rates, but English rates seem to still be tracking right along with the U.S. rates. What is happening in the Treasury market is interesting. This is from Bloomberg in here today, looking at the trend with the red lines in terms of 30-year yields. But it's the bond holdings of banks in here. Look at how these have dropped dramatically. One of the effects also, besides the fear of Fed tapering, is that the repo market, due to banks making changes to fit into Basel III, have reduced repos in here 35%. Which is a huge drop worth $3 trillion. So that is also having a huge impact of creating much more volatile type markets. But we still come back to the Fed. And of course, the Fed is meeting out in the West this week and will be releasing minutes this week. And we look at their impact on everything. And this is very interesting. We've talked about this before in terms of the change in mortgage rates. We look at the 30-year mortgage, for instance, going up from a 365 to a 452, almost 100 basis points in here. But what's interesting when we look at it is that on July 15th, 4.48%. What are they in here today? 4.52%, even with the significant 25 basis point move up in the 10-year Treasury rate. Let's look at 15-year mortgages. 350, rising from a 279 at its low. When we look at August 18th, actually lower at a 3.49%. But then we put the volatility of the bond markets in. That we saw the 15-year mortgage-backed security at 1.78 moving up to 2.55% on July 15th, jumping from July 15th to August to a 291. So when we look at that increase, we didn't see it in the 15-year mortgage rate, but we saw an increase in overall bond yields because of this effect of volatility. The 30-year also moving up 37 basis points in here since July 15th. Is this overdone? Is this market oversold in here? Well, let's go back and let's look at what Dr. Ed talked about to our PRR subscribers. And what he was looking at was the central tendency from the FOMC. Their estimate that they changed in June in here, slightly lower from the March projection, was for GDP to be 2.3% to 2.6% for 2013. Well, let's look at it from the standpoint of actual GDP to date, 1.1%. First quarter actual, the advanced estimate at 1.7%. Then we look at our leading index, which we came out with at 1.3% for the next 6 months. On average, even if there is no change in the advance estimate on second quarter GDP, 1.36% average for 2013. How are we going to get up to 2.6% where the Fed is estimating? Is this a question that the economy is actually moving a lot slower than what the Fed is looking at? Does this equate to Treasury rates moving up at this rapid rate? And is it a fact that the volatility in here, due to significant changes in the market, in the repos, banks selling treasuries, not willing to sit there and hold them in inventory, that all of these things are creating a very volatile situation? This is Jay Brew, co-chairman of Seafried and Brew. Have a great week.